Today's scary headlines are a combination of events. It's the geopolitical uncertainty affecting global oil supplies, but we also had some weaker than expected domestic manufacturing economic data today. And I think all of this acts as a splash of cold water on the face of investors coming off of that record bull run that we saw last year and that record economic expansion. But Neil, look, I think it's a reminder for investors of why managing money is about managing risk, not just about seeking higher returns, why we don't own just Apple and Microsoft when they're responsible for 15% of the stock market gains, it's okay to own some energy, which was the dog of the decade, but energy is underrepresented in most investors' portfolios, and it serves as a ballast, just like gold, just like bonds, just like other areas, to diversify the portfolio. But Neil, it's also a reminder of why we would have to be insane to take this economy for granted. There's so many risks that always are on the horizon that we need to be cognizant of. Look, it's things like deficits. We have record stock market runs. We also have record national debt, $23 trillion in debt. We also have geopolitical uncertainty, as we all know, but we have dysfunction in Washington. So all of these going into an election could be concerns, but the disruption to global energy may not be as meaningful to the U.S. economy as it was in the days of the Arab oil embargo, just because we're getting flashbacks to the Iranian embassy once again. You know, we talk about the transmission mechanism that Jeroen refers to, and the transmission mechanism, energy is a really underappreciated mechanism here because we've had a consumer-led economy the last few years. Consumers been a champion, middle class has been a champion, small business have been a champion. They're very susceptible to energy prices. Again, far less so than 20 or 30 years ago, and the stock market is far less exposed to these sectors. But at the same time, a spike in energy prices may dampen consumer sentiment. It may dampen retail sales. You know, one of the issues we always look at is what is the impact on the Federal Reserve? Will the Fed be more likely to stay on hold? If you soften the consumer, the Fed may be more likely to stay on hold, which ultimately may actually prolong this economic recovery and allow us to push into the next election cycle. So I think there is a bullish story to this. The cooling of sentiment may be well received in Wall Street because it will prevent inflation from getting out of control, would also prevent inflows to the market from getting out of control. So I think tempering enthusiasm sometimes is really beneficial because we want a stable economy. We don't want stock prices exceeding fundamentals or exceeding business activity. And that's the direction we were beginning to head in as inflows from cash were coming into the market in a rapid fashion in December.